Hey friends, Lucian here with the Bullish Bears team. This video is going to be about how an options strike price works and how you calculate and find out your break-even prices when entering into an options trade. So let's go take a look at an options chain of Apple. If I click on the trade tab over here, and I pull up over here, you'll see an options chain for Apple. So down here are the different options strike prices, right? You have the calls on the left side and the puts on the right side. So when you're buying, right, an options buyer, if you're buying a call, you believe the price of the stock is going to go up. When you buy a put, you believe the price of the stock is going down. Again, these purple shaded areas are in the money options over here, and black areas are out of the money. The more in the money that you go, the more expensive the options contract is, because the probability of it expiring in the money, right? If you're an options buyer, you want your contract to expire in the money. The higher the odds of your success, the more money that you pay. So let's just take a look at some examples, like if you were to just buy an options contract, how it breaks down, the cost, what it looks like, and kind of put it together. So right when you come down over here, the price that's closest to the money, so there's a term called at the money. So there's in the money, out of the money, and at the money. At the money is the strike price that is closest to the current strike price, or to the current price of a stock, right? So right now, Apple is at 120.20 right now. So the closest strike price to the current price of Apple would be this one, $120. So if we go right over here, when you go to place the options trade, just showing over here, if you hit right click, buy, and then you go up to single, this would just be buying a naked call option of Apple. So just a quick summary of how this looks. You're buying one options contract, which is the equivalent of 100 shares, with a December 18th, 2020 expiration, right? Where we have the expiration date up over here. It is a call. So I'm buying a call. I'm bullish on the stock. And then this is where you put the limit order in on what price that you're looking to get into the trade. This is a limit order right over here. Day just means that it's filling on the day. GTC means good to cancel. So if I wanted to get in and I can get in other day. Whenever it hits this price, it doesn't have to be on this particular day. It could be in the future. So that's where you can change that to good to cancel if you'd like. But this is just right here, going to place the order, right? So if I click confirm and send before I place this order, let's do the breakdown and see how this all breaks down. So right here, I'm buying one options contract of Apple, which is the equivalent of 100 shares, with a December 18th, 2020 expiration date right over here where the expiration date is. $5.10 is the price I'm paying, $5.10 times 100, right? Because each options contract is 100 shares. So that's why it says right here, max loss is $510. So that's the $5.10 times 100, and that's how I come up with the max loss of $500. Now let's take a look at break-even prices. If you look right here, you'll see the break-even price on my trade is $125.10. How did we come up with that number, or how did they come up with this number? Very simple. The strike price is $120, and we're paying $5.10. So you take $5.10, add it on top of 120. So that means the break even would be $125.10. So basically, by this expiration date of December 18th, 2020, if Apple is at 125.10 by that expiration date, I would break even on the trade. The more Apple is above $125.10, the more money I would make, right? So you can see max profit is infinite, but don't get caught up about max profit being infinite. This is where it could really kind of get caught up and people, oh man, I want to just buy naked options because I can make so much money and the money's unlimited. Sure, in theory, but remember, price has to move in that direction. So if you're just buying on hunches and theories and hoping price is going to go up and you're not charting your stock, you're not seeing how far that Apple could go up or whatever stock you're looking to buy. If you're not charting it out and you're just randomly guessing, sure, it's great that you can make unlimited profit, but that doesn't mean it's going to happen. Right? So that's where it's just really important to remember when you're trading options. Remember, again, odds are more in your favor. Look at this probability of in the money column. You're going to pay more for higher probability of success when you're buying a naked options contract. Remember, there are other strategies like debit spreads, credit spreads. Again, this video is just kind of more of a basics on strike prices, but in our options courses, we teach you how to do the different types of strategies. But I just want to kind of show you order entry, how you calculate your break-even prices, and what your max loss would be. Again, your max loss when you're an options buyer is what you pay for the options contract. So whatever you pay down here times 100 times the number of options contracts. So again, this is $520. We got in at 510. If you had 5 options contracts, the max loss would be 5 times 510, which is around what, $2,500, right? So again, and how you calculate your break-even prices is just take the price of the options contract that you paid and add it on to the strike price. And that's why you'll see when you come down over here, when you go out of the money and you look at, let's say down here, a cheaper options contract, if I go to buy it, you'll see 76 cents. Okay, so the most I can lose is 76 bucks, right? So it's a lower loss. But remember, again, the odds are less in my favor. So that's basically, if you're just randomly buying this, you might as well just kind of hand your money over to somebody else, because you also got to see here, that means 76 on top of that strike price of $135. That is how you get the break-even price of $135.76. Well, you can see the current price of Apple is $120. So that means within 36 days, Apple has to move up about $15 to $16. So yes, it's great that the price is cheaper, but the price has to move in your direction pretty heavily. So this is where, again, don't get fooled by that infinite max profit. It doesn't mean you're going to make it. So that's how you're going to calculate your break-even prices on the stock. Where you find, again, your max loss is what you paid for the options contract. Now let's take a look at the put side. We'll do a put example. Let's go right over here and let's say, again, remember, put, you believe the stock is going to go down. So you believe, Apple is going to continue to fall. Remember, you're not randomly guessing, you're charting your stock. I'm just showing you, for sake of purposes of this video, how to place this order and what to look for. So right here, let's say you believe Apple's going down. So now you're going to go and you're going to buy a put. So you'll see over here, buying one put contract, expiration date of December 18th, 2020. It's a put right over here. You'll see the limit is, as of right now, $5.95. That's times 100. But again, it calculates for you. And you can see right over here how it breaks down. One Apple contract, 100, controls 100 shares, expiration date. And you'll see the break even is 116.55. Now, how did we come up with that number of 116.55, right? So on the put side, just a little bit different. You're taking the 122.50 strike price minus the price that you paid right here, which is $5.95. So that is 116.55. So your break even is by expiration date of December 18th, 2020. You need Apple to fall from this level of 120-ish area down to at least 116.55 to break even. So right here, you can see this does have a max profit of 11,655. Obviously, that would be great. Again, has a cap on the profit, but this is what I'm saying. Don't get caught up in large numbers like infinity and gigantic numbers. You're not going to make that money on the trade, right? So, kind of more of don't worry about the infinity in this type of number. Be aware of, again, when you're charting your stock, knowing what you're doing, not randomly buying calls and puts, being aware of, why you're entering into that trade. This is what needs to happen right here to break even. The more that price falls below 116.55, the more money that you'll make on the trade. That's where the options Greeks and the different components of an options contract kicks in. Again, we explain that stuff in our courses under the Greek section. But just in theory, again, when you look over at delta, delta gives you the amount, again, overall, what a price or the options contract will move per $1 move. So you'll see this number right over here. If Apple goes up $1, the options contract would go up 75 cents. If Apple goes down $1, it would go down 75 cents. Again, there's other Greek components as well, but just kind of gives you an idea and kind of theory how it works. So this is where, how it looks like to enter and exit, or not exit, how to enter into, both a call or a put as an options buyer, how you calculate your break-even prices, which is basically done for you in the system. Again, don't get caught up in infinite pricing, that you can make a ton of money. That's where you can get burnt, and that's where a lot of new options traders lose their money because they just get all excited. Either one, they're buying out of the money options contracts because they're cheaper, but they're just basically handing their money over to somebody else. Yes, the odds are in your favor. You could technically go and say, oh, okay, I have a 90% chance and buy it. Sure, 90% of the time or a lot, depending. It can work in theory that way, but also if you're not careful, they can rip your head off. You can go and spend a lot of money in those deep in the money options contract, and it can be very painful if the option goes against you. You might win on that trade 3 weeks in. It might take you 3 weeks if you get a bad entry, and then you're dealing with a pain of that loss. Like you could pay, let's say, $3,000 for an options contract. You could be down 90% on it for 3 weeks, 3.5 weeks, until it finally turns your way. So it can cause a lot of pain. That's why you want to be careful just buying random calls and puts, and why it's so important to be able to chart your stock. So again, most brokers do all of this for you, break things down, when you go to your order dialog box. If you want to know and you get nervous and you're brand new, just open up your paper account, right? So you can open up a virtual account and practice this, right? So log in not with your real money account, but your paper account, and just practice looking at the order dialog box. Oh, okay, here's my break even. Here's my max loss, max profit. It does it for you. So most brokers do this. So TD, again, this is a TD video right here. They make it very easy. So remember, as a call, when you're buying calls, you want the price to go up. When you're buying puts, you want price to go down. So your break-even prices, again, on a put over here, is with price falling, and it's just the opposite with calls. So hopefully this video on strike prices and order entry helped you, and we'll see you in our community. Enjoy.